Good day, fellow investors. Today I want to discuss some concepts related to creating a portfolio, because a question that I get often to portfolios is, Sven, how much diversification now? Should I invest in this? Where should I diversify? Bonds, this, that? And I think the error is in the question already, because we have this fixed perception we have to be diversified because efficient markets theory, etc., etc. My perspective is significantly different, and that's what I want to discuss in this video. In a recent comment on my platform, I got asked, Sven, if you would start your portfolio now, would you have the same allocations as you have now in your portfolio that you started in 2019? So I started in 2019, and the question is, okay, would you do the same now, or do you have some legacy businesses that evolve there over time? That's a great question, also related to portfolio building, construction, diversification, and in this video I want to elaborate on that. So a common portfolio question that I get idea is that a portfolio can be built in 5 minutes. So you just go, select, go there, or if you have a lot of money, you go to your investment banker, a coffee, 45 minutes, and there you have a beautiful portfolio done for you. Let me tell you that that's the most expensive cup of coffee you will ever drink. Haha. And I find this really wrong. And the reality is that it takes years to build and construct a portfolio. And when you invest in the long term, you always want, if you have good businesses, you want to let them run. So if you bought something cheap and now it's fairly valued, if it's still a good business, it's hard to sell. Maybe you wouldn't buy as much. So what I usually do, when it balances, I sell half or something like that, and then I keep that one good business just to let it run into eternity long term, depending also on other opportunities. So if I would start a portfolio now, maybe the allocations would be a little bit different, but not that much. So why sell a business if a business is paying fat dividends? If it's a good business, it will pay fatter dividends. Then you can diversify over time with those dividends. For example, Warren Buffett bought Coca-Cola in 1988, 1989 and paid $1 billion for the position. Then the stock exploded up to 1998 and he didn't sell. When you look at what Coca-Cola did over the last 20 years, it's a shame he didn't sell, because if he bought Apple or something else, he would have done much, much better. But also think that he now gets about 600 million, even more per year in dividends, and got that year by year. Those dividends got reinvested in Apple, and that's how he diversified his portfolio. So he avoided paying taxes, he liked the business for what he paid here, he liked the dividends, he liked everything. And then, yes, it was ugly for a long time, but over time he diversified into other things by using the fat dividends. Similarly, he likes to think in buying whole businesses. He bought Burlington Northern Santa Fe. Over the last 10 years, he got more out of that for just dividends. So that's also an investing diversification. Now you have Coca-Cola, Burlington, Apple, etc., etc. Diversification, but diversification over a long period of time. So just answering the question on my portfolio, 70% of allocation would be equal. 30% of the portfolio is now, let's say, legacy that I gained by when the position doubled. I like to hold that and then just be diversified based on the quality of the business. If I would have to start now again, maybe I wouldn't buy as much, or I would buy for now something else, then wait for better entries, but that's now. However, if the position is there, you can leave it. It will deliver value, for me dividends, which will then be reinvested elsewhere. And this leads to the concept of temporal diversification. The common idea is that you have to be diversified immediately. And if we look at CalPERS, the Poor Teachers of California pension fund, then you see that they are really well diversified. 50% in stocks, 30% in bonds, 10% in private equity, 10% in real assets, and this is something I would call, okay, diversification. But if you look at the performance, the total returns over the last 10 years, 12%, I hope this is per year, for stocks, of course, over the last 10 years, great, but that's just one part of the portfolio. The rest of the portfolio, so 30%, probably this was even higher because this performed really well, the public equity. So this has had a yield of just 3%. So why diversify if you know it's going to destroy value? Even now, 30% of the fund is in treasuries, so long treasuries. And if we look at the yield of the treasuries, yes, 10 years ago when they started measuring, it was 3%. There you have the yield, 3%. Now the 10-year is 1.4%. Okay, so over the next 10 years, they will have 1% here, and equities also. Don't know, we don't know. Could be negative, could be positive, but this is the cost of diversification. Plus, they have 30% in the portfolio, and the total fees add to less than 1%. So let's say 0.9, I think it is. 0.9 fees, 1.48 yield, so 0.5 is the after fee yield. Inflation 3%, they are just losing 2.5% of their portfolio by holding it in treasuries. So that's insanity for me. So being diversified for diversification, it's just pure plain insanity for me. So I totally disagree with that. Because you are missing two factors. You're missing, okay, let's put our money in what is cheap now and get out of the extremely risky bonds, etc. positions that are out there. Of course, in my portfolio I hold some legacy positions, but if those go exuberantly priced, then I will, of course, get rid of them and buy something that is cheaper. Those are still fairly valued, and that's why I hold. So extremely undervalued, fairly valued, and then you have overvalued when it's time to get rid of things. And another factor that people miss is future income. So diversification, yes, but you can also diversify with future income, especially you know yourself, this is really personal, but it is a concept not accounted for by investment funds or pension funds because they can't think in your money, your future income. Oh yes, they think in your money when they take 0.9% of your assets, but they really like your money then for them. Nevertheless, when you think of investing, if you're just starting and you say you have a small portfolio but you have income over the years that will come in, it's also okay, I think, to start with one stock. If you know that stock really well, you like it, it's cheap, okay, next year you buy something else, over 10 years you have a great portfolio. And if you buy something that's cheap now, tomorrow it will pay off either by stock price increases, higher dividends. You can then reinvest that by selling half it's fairly valued, selling all if it's exuberant, into other things, and over time, like Buffett did, you will have a great portfolio. So my message is that long term, when it comes to investing, I think that people should really think about, okay, I'm building a portfolio over the next 20 years, a portfolio that will create value over the next 50 years for me, and that's why I think the best answer is to diversify your portfolio by itself over time. Not starting by diversifying at all costs just because someone said like that. So just think diversification versus focus and diversification over time. Let's really check this at the Investor Government Compound Calculator. Let's start with 100,000 investment, 0 monthly contribution, length of time in years, let's put 20, interest rate, let's say 10%, and variance 5%. So this is the difference, even this is smaller difference than we had with CalPERS. They had 12% and 3%, but let's just check the difference over years. What can diversification cost you? 10 and 5%. And the results are that with 10%, you have 627,000. With 5%, a third of that. This is really, really important to understand. And these small differences over the long term really get you to big things. And that's why I wanted to introduce here a concept that is different, but I think that increases this long-term value and long-term returns. Of course, we are here talking about knowing what you're doing, about investing in businesses, not in stock prices. If you put all your money in one stock that goes up like crazy and then crashes like crazy, then you risk too much. But really in buying businesses that have a stable position, a moat, the bigger the better. So that's something to think about when it comes to investing, and that's the core of what we talk on this channel. So I think that longer term viewers will understand here my warning. And of course, the more you know, the better you are. Warren Buffett says diversification is protection against ignorance. It makes little sense if you know what you're doing. This makes little sense if you know what you're doing, and that's why I have a YouTube channel, to try to educate those who want to learn and know what they are doing. Charlie Munger also, the idea of excessive diversification is madness. Why diversification, which necessarily includes investments in mediocre businesses, only guarantees ordinary results. Of course, if you are watching this till now, you are not for the ordinary in life. I thank you for that. And that's also my idea for building a portfolio in 2022. I just need one good buy, and I think you know what my good buy at the moment is. Over time, I'll buy or not, we'll see whether it will be still a buy or not. But that's a simple answer. And then you diversify, you accumulate, reinvest those dividends, build those portfolios, and then you have strong fundamental strength, even in these exuberant markets of 2022. Then in 2023 or 2026, there will be other investments, and those investments, by spreading your buys over time, will lead to good returns, a strong portfolio, one that you can sleep well on. And that's my message for investing also in 2022. Thanks for watching. If you want to check more about what I do, you have here some links also in the description below. Thanks, and I'll see you in the next video.